Hi, welcome to this video, David, which is on an essential trading book. Now, in terms of this book, I think any beginner coming in the market should read it before they start to trade. Now, the book is really good for any traders at all. It comes from one of the best traders of all time, Ed Thorpe. The book is a man for all markets. Now, in terms of the book, it will help you develop and define a trading strategy with an edge. Also gives good insight into proper money management and also the all-important psychology of winning traders. Now, Ed Thorpe is not as well known as, let's say, George Soros or Paul Tudor Jones, but his track record is up there with the best traders of all time. His hedge fund, Princeton, which ran for 20 years, never had a losing year, and he only had 3 losing months in the history of the hedge fund, which is remarkable. Also, the hedge fund had very minimal drawdown against profit. Now, in terms of Ed Thorpe, what we're going to do is we're going to do a quick review of the book, look at some essential trading lessons from it, and then finally I'm going to finish up with my favourite quotes from Ed Thorpe. Now, in terms of the book, let's go and take a look at it, the lessons we can learn. Key lessons from the book. I'm on Amazon, where you can go and buy the book if you wish. Now, in terms of something that we stress in a lot of our videos, is if you want to learn Forex trading the right way and win, don't just learn from educators online. The vast majority of them on YouTube have never traded. Learn from traders who've got great track records like Thorpe, how they view the markets, how they developed their strategy, how they got an edge. Okay, now in terms of Thorpe, very interesting in terms of his life story, because he started off beating casino games in Vegas. Before he came along, most people thought the games like blackjack could not be beaten. He managed to get an edge over the house. He took the knowledge he had of gambling into financial markets. There's a big similarity between winning at blackjack and winning in financial markets. Okay, he came into finance a big way in the 70s, had a really long career. So the book is actually a history of the markets and how they've changed over time. Thorpe noted that strategies when he first started trading were no longer working. He had to adjust. We all do. Markets have changed significantly over time. Now, book just $10 or less, a really great bargain in our view. Now, in terms of the book, the only criticism I would have of it is it's a bit wordy and overlong. It's well over 1,000 pages. It could have been a bit shorter and more concise, but yeah, it's a minor criticism. You can see ratings wise, nearly 1,000 ratings. Yeah, 4.5 stars. Most people who didn't give it 5 stars, yeah, thought it was a little bit wordy as well, but a minor criticism. Right, let's look at some key lessons from Ed Thorpe and then finish up with some of my favourite quotes from him, which I think contain a lot of investment wisdom. Right, lessons that we think are important first. Right, 7 points from Ed Thorpe I want to go through. Now, in terms of the first one, I've already alluded to this in the intro to my video. Common mistake is not to do this, which Thorpe did. A trait Thorpe had was a tendency not to accept anything he was told until he proved it to himself. Now, it sounds obvious advice. Most beginners just don't do this. They just go online, take someone's word that a strategy is going to be good or techniques work, without doing research to prove it. Now, if you don't research and prove an edge to yourself, how are you going to follow it when you hit a losing period, which you inevitably will? Your discipline and confidence will just go. You need to have rock solid confidence in your edge. Okay, so you need to do your own research. Point number 2, similarities between gambling and trading is high, particularly a game like blackjack. Gambling focuses on probabilities and a defined edge. Now, Thorpe wrote the book Beat the Dealer with a simple card counting strategy anyone could learn that would give them an edge and allow them to win over the longer term. And yeah, traders need to see Forex in that way. Okay, you'll have an edge, but the times it's going to be in your favour in trade setups is going to be low. Okay, if you take blackjack, basically the game favours the house 93% of the time. Most traders who've got successful strategies will be very, very patient. You have to be, because your edge is not going to be on the majority of trade setups. So teaches patience. Most traders want to trade too much low odds trades. They're impatient and they lose. You only want to trade when the odds are heavily in your favour. And always keep in mind, any trade can go wrong. So you've always got to be looking at the worst eventuality, which I'll come back to in a moment. Now, in terms of point number 3, traditional chart analysis doesn't work. I'll put John Murphy. He wrote a book on technical analysis. It's seen as kind of the Bible for technical traders. It only works in a textbook. It doesn't work in the real world. And there is a big focus today in terms of technical analysis. Yeah, people want to trade patterns, okay? And as Thorpe says, people see patterns in things, not for explanations when there are none. Now, if you look at majority of educators online, they basically promote pattern trading strategies. They only work in hindsight. No professional trader would use them, yet the majority of beginners do, okay? Now, in terms of markets changing, Thorpe was a technical trader who was looking for mispricing in his trading strategy. He traded technically until 2002, when the strategy just really wasn't working as well as it should, and he needed to put in other inputs. So he did fundamental analysis. He still entered the trades technically and managed them technically, but he had a fundamental knowledge of the markets he was trading. And that is the way today that most top traders trade. Sure, they'll use technicals, but they will have a knowledge of the fundamentals and the sentiment towards them. Now, markets are constantly evolving. And I think why technical trading started to get less effective was because of the internet. You got more noise, trends are not so smooth. You need to have basically a knowledge of fundamentals and sentiment to win. Okay, trading short term. Now that has become more popular than ever with basically the internet, and also dealing fees. The spreads you can get today, compared to back in, let's say, the 70s, they've come down dramatically. So traders want to trade short term. Okay, now if you read the financial media, every small move in the markets is explainable. Okay, but as Thorpe notes, they're unable to distinguish between statistical noise and unusual events. If I go on FX Street, which I quite like as a site, they will try and sort of justify a 20 or 30 pip move with some meaningless bit of news. Okay, now in terms of this, you can't explain every twist and turn of the markets. Okay, you need to look at noise levels. Okay, now in terms of noise levels in most pairs at this moment in time I'm doing the video, it's going to be 100 pips or more. So you've got to take that noise into account. Okay, point number 5, best traders stay within their circle of competence. Warren Buffett and Charlie Munger make this point as well. Work out what you're good at and then build your strategy around that. So for example, if you've got a sort of good mathematical mind, you might want to be looking at mispricing in the market, volatility, etc. You might have, like I would, have a sort of, I would consider a level of competence in measuring sentiment extremes. When the market gets to a bullish extreme or bearish extreme, then I can go against the majority. Okay, you need to work out what your circle of competence is and then build your strategy in relation to this. Okay, when you get an edge in the markets, you've only got one where you can make a rational case that withstands your attempts to tear it down. Now, in terms of an edge, you should know why it works longer term, but you should also work out the weakness in your strategy as well. Okay, now every strategy will have a weakness, and you need to basically mitigate that weakness. So, for example, for me, trading sentiment extremes, I can use very tight stops. Okay, that means I can get stopped out a lot of times, and the winners that come are going to more than compensate for the majority of my losers. Now, in terms of when you develop a strategy, consider this. Thorpe was a graduate of MIT in mathematics, but he doesn't really credit that for success in his trading. He kept things incredibly simple. If you look at the blackjack card counting strategy and beat the dealer, incredibly simple. So were his financial strategies. He was a big fan of Occam's razor. If you don't know what it is, look it up on the net. It's a theory that the smaller the number of inputs, the better as a general rule. We don't have too many inputs to generate a trading signal. When you're developing a strategy, ask yourself why markets are inefficient and how you can exploit this fact. I've just said, in terms of the way that we would do it, it would be that markets, they always have a tendency to overshoot the bullish or bearish extremes. That's when you can hit with an edge. Okay, another edge would be, in my view, trading really big fundamentals that last for weeks or months and keeping your stop outside the noise so you can stay with the big trend. You have to work it out for yourself. There's a couple of examples. The balance between risk and reward. What is the ultimate bet size? Thorpe was a very conservative trader and based his money management on what's called the Kelly criterion. You need to go and look that up. I can't explain it in detail in this video, but it'll give you the ultimate bet size against your win-loss ratio in your strategy. Okay, so I'd strongly recommend you look that up. You do not want to be risking too much in the markets. It's a recipe for a wipeout. A lot of traders are trading too big in terms of their total exposure. If everything goes wrong, how much exposure should you have? If you read Thorpe's work, I think his biggest risk exposure about 5%. You don't need big bet size. Okay, now you should have a long-term focus on compound growth. Compound growth. A lot of traders don't look, long enough forward. If you take compound growth, let's say a $10,000 account, let's say you compounded at 50% a year, how much would you have in 10 years? You'd have about 500,000. Okay, so money makes money. It becomes a snowball effect. Mental toughness, discipline, how to acquire it. Thorpe basically makes the point that you should be betting very small to prove that your edge works. Okay, and then when you are really confident in your edge, then you can step up your bet size. You need to practice in the markets, prove that the edge works. Another point which I just went by was you should always vary bet size. In a probability-based market, variation of bet size will maximize your profits and limit your losses. So if you're winning, you can risk a bit more on a trade if the setup is correct. If you're losing, you cut back position size so you don't go too far behind. Okay, many traders, when they go behind, want to increase the bet size and get back too quickly. That's not a good idea. So there's fairly basic points in my view from Ed Thorpe, but they worked for him, and they can work for you. Now, what I want to do is finish off with some of my favourite quotes from Thorpe. I hope you enjoyed the video and found it useful.